the neighborhood finance professor, and welcome to the Black Financial Channel. Some of you have asked me, how do you make money from the stock market? Well, since I want everybody to become an investor, I believe that all of our people in our community especially need to become investors. I'm going to show you how money is made in the market, why buying stock turns into money. This is real basic, but this will help you kind of understand where it comes from. So the fact that I want you guys to make a lot of money, is pretty evident. I want you to get rich. I want you to be funky rich and super happy. And so let's use an example with Facebook stock. Let's assume that you buy a share of Facebook. This would be the ticker symbol. The ticker symbol is kind of like you can almost consider it to be like like initials or a nickname for the stock. So this is how you look up a stock, with the ticker symbol. And so let's say you buy a share of Facebook stock and it costs you $200. Well, how does that $200 grow into more money? And why are people in the stock market all smiling and happy and really doing well and just, looking like they're living their best life? Well, it's because these companies are making money, and they're pretty much giving money to investors through two key mechanisms. One is through dividends. We'll put a D there for that, and capital gains. Those are the two ways that stocks make money. Well, a dividend, what does that mean? Well, a dividend is typically built on what they refer to as a dividend yield. And so a dividend yield would be some yield that they promise you as a result of your investment. So for the dividend yield, for example, might be 5%. Right. So a company might say, we're going to pay 5% of our earnings back as dividends. Well, what does that mean? Well, that means that if you have $200 worth of stock, well, 5% of $200 is $10. So what they would say is, okay, everybody, we've went out, we've taken your money, we've run off and we've done things with it, and we've made a profit for you because you are the shareholders, which means you own the company. We just work for you. And we brought you back a dividend of $10 per share, which means that if you have, say, 100 shares, which would cost you about 20K, right? 20 grand. So you save up 20 grand, you have 100 shares. Well, if Facebook's paying a 5% dividend yield, you would make $1,000, right? So there you go. Cha-ching, you're balling, you're making money, and then you just rinse and repeat, and next thing you know, you're filthy rich. So what's the next way that companies make money for you? Well, there's also capital gains. So capital gains are when the company pays no dividend. So let's say that they say our dividend is going to be $0 because we're going to take your money and we're going to go and we're going to invest your money, right? So they're seeing these investments, these great opportunities that are going to make money for the company. So the company goes off and they invest your money, and they end up coming back, and what they do is they do an earnings announcement, right? So every quarter, there's what they call earnings season, where earnings are announced, and you find out if your company is a hero or zero. Well, for every earnings season, there's an expectation. The earnings expectation is what the analysts expect the companies to make. And so what happens is that you have almost like a financial version of a debutante ball, where companies come out and announce their earnings, and they announce their actual earnings. And if the actual earnings exceed the expectation, then you tend to see the stock price go up. That's where capital gains pop in, because now your company that used to be worth $200 a share might be worth, say, $212 a share, because you effectively are a participant in a more valuable company. So you have bought stock in the company's gone up in value. If you want to get your money, you then have to actually sell some shares to get some of that money out. With dividends, you're getting the money directly in your pocket. It all has to do with whether or not your company is what they call a growth company, or a company that is what you might call a cash cow. Cash cow companies don't grow. They just make that paper. They make money. They pay dividends. Growth companies don't pay dividends because they're they're investing your money, and they're making money for you because they're better at growth than you might be on your own. So there you go. That's a quick tutorial on how money gets made in the stock market, and why owning stock is the number one wealth driver in America. That's the number one way that people are getting rich in this country. And so if you haven't started buying stock yet, I encourage you to do that. I've got a free training you can take a look at. If you go to firstshareofstock.com. My handwriting sucks, but you get the point. Firstshareofstock.com. If you go there, there's a free training there, and also you'll get on my email list. I have written thousands of articles and done thousands of videos on investing, and I have a PhD in finance, and I know what I'm talking about. I can break this down for you in a trillion different ways. So just get on the email list, and we'll get you cracking. So take care. Hit the thumbs up button. God bless you. Have a good day. I'll see you soon. Peace.